Housing booms don't end when prices peak. They end when buyers disappear. And in Nashville, buyers are disappearing. This has changed Nashville into a niche cultural destination and one of the most hyped housing markets in America during the pandemic. State income tax rate, 0%. Corporate expansion, movement of the labor force into more expensive states, and interest rates were low. It did not simply lead to growth. It was acceleration. The average single-family home in the Nashville metro area increased by around 56% between 2019 and 2022. In 3 years, that is an extraordinary move. It felt like a lasting change. However, by 2026, it will no longer be a question of how high prices will rise. The question is whether that boom was sustainable. Ever since it hit an all-time high in the summer of 2022, Nashville home values have lost about 4% of their all-time high. That appears to be stable on the surface. To the mind of the layman, it seems that it is a gentle landing. Nevertheless, housing markets do not usually reflect their distress solely from headline prices. One has to look at the inventory to know what is going on in Nashville. The most significant directional measure in real estate is inventory. Active listings in a healthy pre-pandemic Nashville usually ranged from 7,600. By January 2022, it had dropped to about 1,500 listings. That is an 80% decrease in supply available. This was the driver of the price explosion. There was competition among the buyers over a few homes. Several offers got normalized. Inspections were waived in favor of regular inspections. The prices lose their connection to the fundamentals when supply is exhausted and demand is high. Housing cycles go both ways. Inventory disappeared and reappeared almost immediately. By November 2022, listings had rebounded to approximately 7,600, virtually putting pre-pandemic levels back. Yet there was no end to the reversal. The inventory level also continued to increase after stabilizing. By last summer, Nashville had around 11,000 active listings. Within 3 years, the market shifted to oversupply. That shift changes leverage. Sellers whose offers were previously made in 24 hours are now observing properties for months. Certain observers attribute recent declines in inventory to seasonal factors and indicate that stabilization is underway. Nashville is a very seasonal housing market. The summer is usually the highest season of inventory, then drops during the winter, reaches its lowest point around February, and then starts climbing again towards spring. The fact that inventory decreased during winter is not essential. The most important thing is where the floor is taking the shape. The seasonal low in the past year was about 7,600 listings. The bottom this year has already gotten nearer towards 8,700. That is, the market is going into the spring season on a much higher base. Assuming that course, Nashville might outpace the Nashville listing high of 11,000 last year. High inventory combined with high mortgage rates does not bring balance. It is hesitation. And indecisiveness brings about slow sales. You are forced to look at monthly payments to gauge the pressure on buyers. 10 years ago, an average house in Nashville with a 20% down payment would normally cost about $1,200 a month, with taxes and insurance added. Nowadays, the same way of life costs about $2,700 per month. That is about a 125% increment in the cost of shelter in a decade. Monthly payments have gone up by almost 90% since 2020. Affordability has not only become tight, it has structurally shifted. The typical counterargument is that Nashville's economy has grown with rising prices, corporate relocations, population growth, job creation. However, as the plots of mortgage payments versus the average income levels, it becomes obvious that there is a disconnect. An average mortgage was about 25% of gross income as spent by a typical resident in 2021. When the pandemic boom reached its peak, it hit almost 46%. Even today, when the prices have started to moderate a bit, the figure is close to 38%. Nashville had been in the 20–30% affordability zone. The existing level is still high relative to long-term rates. Affordability will be limited without a significant wage increase, a significant reduction in mortgage rates, or additional price reductions. And where it is not affordable, demand is diminished. That is a weakness that can be observed in pending sales. A pending sale is a house under contract. It is an indicator of future price movement. At present, Nashville is registering around 16% year-on-year growth in pending sales. Among large metro regions, that puts Nashville last in terms of buyer activity. This is not a collapse in transactions, but it is a clear slowdown. Pile the data and a trend comes out. Rising inventory, elevated monthly payments, declining pending sales. Such traits are not those of a booming market. They are the indications of a recalibrating one. Nevertheless, another dynamic is taking place under the carpet. New construction. The Nashville metro home builders were aggressive in the boom years. Nowadays, there are numerous mortgage rate buydowns at 4.9% and large closing cost credits to clear inventory. This forms a strange relationship. There are resale sellers in certain neighborhoods who are selling 5-year-old houses at around $460,000. Simultaneously, there are new construction projects nearby that will provide brand new houses at the same price, with financing options that save a few $100s per month. For a buyer comparing options, the decision is mathematical. The new construction could be cheaper in terms of monthly payments, even if the sticker prices are the same. When expectations are based on 2022 values, sellers tend to use the peak prices of their goods and services privately. Constructors work differently. They react to the balance sheets and the absorption rates. Inventory accumulation causes builders to reduce incentives or lower prices to sustain sales volume. This exerts a negative impact on the general market. When developers are on discount to clear stock, resellers will have to readjust or wait. This forms what may be referred to as a resale freeze. Buying and selling move slowly because sellers are afraid and buyers are awaiting better terms. Nashville is not collapsing. It is, however, being structurally fractured. The extreme supply shortages and historically low borrowing costs contributed to the boom years. Today, supply is recovering and borrowing costs are high. Such a combination puts power in the hands of buyers. This will cause gradual stabilization or more profound price adjustments depending on larger economic factors. Mortgage rate direction, local wage growth, migration trends. However, the statistics indicate that Nashville is no longer in the growth period. It is in correction mode. Inventory is higher than historical. Affordability is still tense. Demand pointers are undermining, and construction workers are fighting over a dwindling number of skilled purchasers. The very city that became a symbol of the pandemic-era momentum is now an example of how a housing cycle can turn in reverse, not through panic, but through mechanics. Price pressure comes behind an increase in supply and a decrease in demand. The next year will determine whether Nashville stabilizes or continues its reset. At this stage, the underlying data indicate the market is under pressure. That is why Nashville is one of the most significant housing markets to watch in the United States today.